Ladies and gentlemen, allow me to welcome our next guest, Mr. Tom Bradley from Steadyhand Investment Funds. Mr. Bradley, please.
Thanks. Well, thank you. Let me start with a question. How many here have been an investor for 1 to 5, or from 0 to 5 years? 5 to 10. And don't be bashful, 10 or more. Okay. And I think I know the answer, but how many invest in individual securities, stocks or bonds or something else? So, any invest in funds? Few? Okay. Okay. Good. Well, that'll, I sort of suspected that. What I thought I'd do today is give you just a little background on where I'm coming from. I'm going to try and not make it a commercial, just to give you some sense of set you up for the conversation we're going to have. But I've been in the business 27 years and started on what they call the sell side or the brokerage side as an analyst in Winnipeg, Manitoba, where I grew up. And there was a firm called Richardson Greenshields had its research department there. So it was a good marriage. There weren't many jobs in 1983 to get research jobs, so the fact that I was willing to go to Winnipeg was a huge uptick, and I got in the business coming out of school then. Spent 8 years there, mostly as an analyst, did some managing, but then crossed the street to what they call the buy side, or asset management side in '91. That brought me out here to Phillips Hager & North, where again I did research, stock research. I'm an equity guy. Then eventually got into management, became, as my partners reminded me, overhead, and eventually as CEO, ran Phillips Hager North for just under 6 years. So I left there in '05 and started Steadyhand, and I think you'll get a little sense of why I did that, and I'll try and take you through it pretty briefly. So many of you won't have heard of our firm. It's a wealth management firm. We started just over 3 years ago. We work with individuals only, and that's I spent a lot of my career working with pension funds, managed hundreds of millions of dollar clients, but we're strictly focused on individual Canadians. We'll talk about this in a minute, but we have a little different distribution model. We certainly work through dealers. The brokers that you deal with, whether it's discount or full service, could buy a Steadyhand fund, but our model is focused the other direction. We're just over 100 million at this stage, and I encourage you all at some point, if anything twigs your interest tonight, just for 3 minutes go to steadyhand.com, which is the source of all our knowledge, and we've invested a lot on the web. The previous conversation, I think, underlines that, so I encourage you to go there. Why did we start Steadyhand? James's conversation about the ad industry was fascinating and so relevant to why we started Steadyhand. We think the industry has got very confusing, and the sign doesn't, pretty much captures what a lot of clients that are maybe a little less sophisticated than this group are up against. And just to give you, like James did, just give you a sense of what were we thinking, what was our core group that started Steadyhand thinking when we started. Well, we thought the industry was getting fat and flabby. We've been very blunt in all of our communications and my writing in the Globe, etc. Fees are too high, portfolios are too bloated, the distribution system is just too bulky. As a result of that and other things, we saw an industry that had got so focused on benchmarks. And what I mean by that is indexes, the TSX, the S&P 500, etc. And that we have a whole generation of money managers, maybe there's a couple of you in the room, who are they run their life and their portfolios off a benchmark. So they want to know whether they come in the morning and they compare their portfolio to what the TSX looks like. They don't come in the morning and say, how can I find a cheap stock for my clients? And as I think the returns in the industry have reflected that. We thought that the baby boomers, and this is playing out to some extent, would be hobby investors. And the baby boomers, for those of you who aren't baby boomers, you'll be pissed off, but baby boomers change everything in our society. And we thought there was a good chance that if there was this much of the market that was hobby investors like yourselves, we thought it might expand, and that would be an opportunity for us. We thought the internet, would be, seems corny, we've had it for so long, but the maturing of the internet and the baby boomers would level the field for us and allow us to compete against the Royal Bank and Fidelity and Trimark. And in our little niche, which I'll talk about in a minute, we had very passive competitors. And I know that because we had a massively successful firm at Phillips Hager and North in wealth management in a model nobody else in the industry really got for many, many years. And everybody else envied, but nobody did anything about it. So I don't have time, and I was going to talk a little bit about how we married the strategy book, Blue Ocean Strategy, with sort of our investment philosophy. But I left the slide, I'll leave the slide up for a minute really to say that if some of you are looking for a good basic investment book, the David Swenson book, some of you have read about him, he's the Chief Investment Officer of the Yale Endowment, and been very successful. They've had a few bumps in the road the last year or two, but in my view, his star has not lost its shine. It's a great read. It's not a light read, but it's not a textbook either. It's somewhere in between, and I encourage you to look at that, or if you know people that need help. But we built our company off this book. It's kind of our Bible. We've got all of our staff have pictures holding the book and all that corny stuff, because he hates the mutual fund business. He thinks it's too bulky. Sound familiar? Too bulky, too high fee. There's too much churning in the portfolios and of clients' money. So we said, okay, he hates it. What can we do to fix it? And so that's what we're trying to do. I'm going to skip through that. So basically what we've done is created a set of funds. They're proprietary Steadyhand funds. There's 5 of them. And typically funds are sold through, we've depicted the middleman as a fat cat, sorry. There's a few advisors in the room, and I'm generalizing grossly to make a point, and on the way to the client. And really what Steadyhand's done is we are working with many middlemen to deliver our expertise, but we're also going directly to the client, and that's maybe the unique feature. That's the tough challenge we have. James has his challenges. How do we build awareness with that end user? Most money managers trying to get attention of the middleman, and all their efforts are focused there. We're trying to go around that.